Portfolio concentrations, roughly where it has been. The top 20 make up about 50% of the portfolio, and the trust had 53 equity holdings at the end of the year. The largest holding remains Azur, which is the owner and operator of airports in Latin America. Other significant holdings remain such as TSMC, Broadcom, AbbVie. There is 18 fixed income holdings, which make up about 6% of the portfolio. So the trust's, concentration levels are still pretty much where they were. At the country level, the geographical perspective, there is 26% in North America, 25% in Asia, about 28% in Europe, and about 12% in Latin America and emerging markets. And again, that's roughly where we were, throughout the majority of last year. At the industry level, significant positions still remain in financials. It's about 15%. Technology and healthcare are both about 14% of the portfolio. We have a sizable exposures to staples, about 10%, 9% of the fund, in energy. The sole zero exposure that we have remains within consumer discretionary, and that's really just driven by us not really seeing the level of yield or the consistency in dividend from many of the companies that we come across. So that's the only zero exposure that remains at the industry level within the trust. So we think there's a nice balance between the taking conviction where we have it, but also ensuring that we have the adequate levels of diversification. Fund performance has been and remains robust. The share price was up 20% last year, and the NAV increased by 10% last year in what was obviously a very tricky market environment. So the trust behaving in that manner, performance has been and remains robust. The dividend recovery, Mar International tries to pay an above average dividend yield, which it attempts to cover from the underlying investments that we make in the portfolio, and that's been difficult since the COVID-19 pandemic. But the recovery on the income side has also been pleasing. The recovery in cash flows and dividend payments that we've been seeing from companies means that we're hoping and pleased with the journey back towards covering that dividend. The one sort of tricky element to the investment objective is that we want to increase the dividend in real terms, so above the dreaded rate of inflation, and given that RPI and CPI finished the year at 13.4 and 10.5% respectively in the UK, that's going to be one element of the mandate, which is obviously going to be very difficult for us to achieve. However, in terms of capital performance, that was very, very robust last year, which we hope shareholders are pleased with. Net gearing remains pretty stable at around 11%, and the trust still has its sizable revenue reserves, which were 63 million as at the half year. Not too many portfolio changes to really highlight. Markets were also quite strong towards the end of the year, and we're not necessarily convinced about the rationale behind that market move. So activity did tail off in the second half of the year. Towards the end of the year, we did begin reducing a little bit of names such as Indo Cement in Indonesia, and then also Lotus Retail, which is a retail property company in Thailand. We just begun to reduce the exposure to those names at the margin towards the end of the year, and the proceeds from that really just put into existing names in the portfolio which had been weak over the same period, and we don't mind a little bit of short-term weakness in stocks that we really, really want to own in the longer term. So we did add to holdings like Siemens, the industrial stock in Germany, Enel, which is integrated utility in Italy. We added to Samsung Electronics in South Korea, Johnson & Johnson, the US-based large pharma and medical equipment manufacturer. So a couple of small reductions and then moving that capital into names which have been weak over the same period, is really the main sort of transactions that we undertook in the second half. The trust behaving quite well and performing quite nicely during the period meant that we're actually quite comfortable with how the trust is currently positioned, and if markets aren't really giving us the opportunity, turnover should typically be a little bit lower, and that's what we saw in the second half. Two holdings that we would choose, and we always like to go to the larger holdings within the trust. And two that we've not raised before would be Bristol Myers Squibb. The Bristol Myers is a US based pharmaceutical company, and it's in the process. It's interesting because it's in the process of losing exclusivity over one of its major cancer treatments called Revlimid. And in years gone past, that's been a 12 billion, or nearly 30% of revenue have come from that drug. What was interesting is that they've managed to negotiate to manage that loss of exclusivity over several years. And what that has done is given them the opportunity to try and replace those revenues. And we're quite pleased with some of the promising treatments that we've seen the company develop in recent times. Opdualag, which is another cancer treatment. We have Camzyos, which is used in the treatments of hypertrophic cardiomyopathy. And then Sotyktu, which is a psoriasis treatment. And the more recent developments of these drugs and what we've been seeing from them in terms of growth means that we think the company is kind of on track to replace the revenues that they're going to lose from their blockbuster drug Revlimid. The market isn't really paying too much mind to these new drugs. We think they're underestimating the opportunity set there. And in the meantime, a stock like Bristol Myers will offer you a nice 3% dividend yield with attractive mid and high single digit growth in that dividend over 1, 3 and 5 years. So we would highlight Bristol Myers. And the other one would be Total Energies, which is the French-listed, French-based oil and gas super major, which has got its key assets in West Africa, the North Sea, Brazil. And it's very well balanced in terms of its underlying assets. It's got a very great quality of a portfolio of assets available to it. Oil and gas prices have obviously been elevated throughout all of last year as a result of demand, as a result of the conflict between Russia and Ukraine. And the company's been really generating very, very attractive cash flows as a result of that. They bought back $7 billion worth of stock last year. They increased the most recent quarterly dividend by 7%. And it's just a very well-placed company, very well-managed company. They continue to spend sensibly into the energy transition, and they'll invest up to $5 billion in renewables this year. It's also got one of the sort of best balance sheets relative to peer group. Net gearing's about 7%, which was something that we obviously take a close look at. So it's a well-placed oil and gas company, one of the best in terms of management, in terms of its financial robustness, and in terms of the the cash flows that it's been giving back to shareholders via dividends. So those would be the two companies that we would try to bring to life. The future themes at the moment with regards to this year is I guess to what the rate at which inflation does ease throughout this year. Does it remain sticky? Does it come back quite sharply? Does core inflation remain a little bit more stickier than the headline numbers? And then at which point that allows central banks to perhaps go into reverse with regards to the interest rate cycle that we've been on. The other thing that the market's debating with itself is the extent to which we do experience an economic slowdown, in which parts of the globe, if indeed any, we do see recession, and the extent to which any of those last. In terms of earnings, earnings expectations have continued to come down. The latest earnings season that we've seen, how I guess disappointing if you compare it to recent history, it was relatively robust in our opinion in terms of the market environment and the tough trading conditions. So there is a lot to contend with. The other sort of unknowns, major unknowns, are some of the geopolitical tensions that continue. Russia-Ukraine conflict continues to dominate headlines. There are ongoing debates and spats between the East and West. And then we have a Republican primary towards the end of the year, and that that will definitely bring a bit of market noise as that gets underway. But plenty of themes to focus on. How we're really trying to play them as it relates to the trust positioning is to again take real high conviction where we have it and make sure that the core positions in the trust really do reflect where our best ideas and where we have comfort. But then also in behind that to make sure that we've got adequate levels of diversification, and the trust proving itself to having been resilient and in what's been a difficult market environment does give us a degree of comfort that we have that side of it positioned quite nicely. What we have to look out for is if there are any periods of market weakness or volatility, that being long-term investors, that we look to take advantage of that and position the trust accordingly for what's coming ahead.